I mean, they try to make money using other sources. Yes. Yeah, order flow. That's the $5 thing I'm paying a month. That's not much of a money. Obviously, if you're only investing $100, that's a lot of money. But if you get millions of dollars or hundreds of thousands of dollars trading there, it's not much of an issue. Uh, there are certain fees on option trades. Even those used to be free, but now exchanges charges you something. For example, anytime I execute an option trade, I think they charge me 3 cents a share, something like that. It's a small amount. Uh, I mean, depending upon the option, it could be a big percentage, but options are typically done over multiples of 100 shares. So if I have an option where the option price is $5, that means the whole thing is actually worth $500. To get out of that trade, I only have to pay $3 as the fee, which is not much. I mean, back in uh, 80s, 90s, commissions were huge, and it didn't depend on the trade size. You paid exactly the same commission whether you bought a $50 worth of stock or $200 million worth of stock. That was it. Now, I mean, especially early 2000s, pretty much Charles Schwab first came into that discount brokerage business. Then Fidelity became one of those. Now, pretty much everybody's there. E-Trade, Robinhood, and similar people. Now, so it has become a lot more democratic, but it, with the advent of speed of trade, it also kind of created chances for unnecessary market fluctuations. Sometimes, since we can respond so fast without necessarily being able to absorb any given information, uh, you may see, especially intraday, big fluctuations. About a few years ago, this was maybe 10 years ago, look it up, it's just called a flash crash. Suddenly, out of nowhere, the entire Dow Jones index tanked 10% within minutes. Why? Because there are high frequency traders. These guys have powerful computers. In fact, people were uh, paying premium to buildings that are closest to the New York Stock Exchange so that they could execute their orders a lot faster. I'm serious. This is not a joke. And right or wrong, there is a lot of algorithmic trading going on. You write a code based on some of the patterns you think that are there, at least for short term. Computer actually executes those trades, but sometimes there's just perfect storm of events. Everybody is trying to do the same thing. At the end of the day, better than even with today's AI capabilities, there aren't that many distinct uh, patterns that people can disagree on. They're relatively small but somewhat significant correlations. And as soon as they see that, everybody jumps on it. When everybody jumps on it, same thing happens. At some point, people realize it's just a random thing and it comes back up. But in the meantime, stuff happens. Even biggest crashes can depend on this sort of stuff. I came to this country first in September 1987, the day after my first birthday here, October 19th, 1987, Dow Jones Index, not talking about, small stocks, lost 20% of its value in one day. We're talking about the 30 largest companies in the United States. Was U.S. economy doing bad? No. I mean, it wasn't doing great either, but it wasn't doing bad either. There was no recession. The Papa Bush, no, it was the second Reagan administration. And part of it was market was thought to be a little bit overvalued, and people started selling. Now, those days, options markets were relatively new, but we kind of had learned from options theory, at least theoretically, you can synthetically replicate an option, or you could do synthetic portfolio insurance. Suppose I like a stock, let's say Citibank those days. Now it's not one of the big banks, but Citibank used to be Citibank. Now we actually have a rhyming name for Citibank that I'm not going to say. Instead of CI, it starts with SI, SH, I'm sorry. Uh, at that point, the largest and best respected, uh, both in US and internationally. Anywhere you went to the world in 1987, you had a Citibank branch. I mean, back in 1999, I went to Karachi for business and we did most of our business meetings in Citibank buildings. Okay, I like Citibank, but maybe overall I'm concerned about uh, the market itself. All I'm doing is I like Citibank more than the market. So what am I going to do? There are two ways to kind of hedge these things. One of them is to buy Citibank, short the overall market. There are so-called futures contracts. Uh, in the futures contracts, you trade the entire index. Okay? You can actually say, I'm willing to sell it at this price. You don't even put much collateral. It's relatively simple. And they also tend to be quite liquid. So doing transactions and futures contracts are a lot easier. And oddly enough, stock index futures do not trade in the same place as the stocks themselves. For example, S&P 500 futures, they trade in Chicago Mercantile Exchange. In the old days, it was called Chicago Board of Options Trade, and they merged later on. And given the communication differentials those days, these markets did not necessarily know about them much. Now, since options markets were not that deep at that point, uh, there is kind of an approach we know better right now to options trading. You do synthetic hedging. Let's say, okay, I bought Citibank, and I'm concerned that S&P 500 could go down. So I'm going to go ahead and buy a put option on S&P 500 normally. Put option means I want to buy the right to sell the index at a certain level. For that, I need to pay a premium. But or one of my clients may actually ask me to sell them. I sell them the right, but I need to cover myself. And the way you typically do that is, I cannot simply short the entire market, because if the market doesn't go down, that short is going to make me lose money. But I also cannot not cover either. If the market goes down a lot, I'm going to have to compensate my customer. So there's kind of a theoretical number. It's called the delta of the option. It's basically a kind of a local number, just like the interest rate risk in bonds. As the value of the stock goes down slightly, what is the expected decline or increase in the value of the option you sold? Okay. If the option was what we call at the money, which means currently the stock's trading at $100, and I sold my client the right to sell the stock back to me at $100. They don't have to use it, but they could. And typically that delta is 50%. That means if my client has right to sell me 100 shares at $100, I should short about 50 shares. As the price goes up, that delta goes down. So I basically reduce my short. Uh, as the price goes up, delta goes down. As the price goes down, delta goes up. So eventually, if it goes down a lot, I'm 100% short so that I can cover myself. And the trouble with this is, you do this, if you do this synthetically, you do this over 500 shares. Or if you're doing it on Dow Jones Index, you're doing it over 30 shares. So if some of the major stocks in the market starts going down, overall index is coming down, right? So if index is coming down, you know your delta is going to increase, so you're going to have to short even more. Even though you're not actively involved, you're basically contributing to the speed of decline. That's pretty much what happened that day. And those days, we didn't have what we now call circuit breakers, or exchanges didn't have any ability to say, let's stop trading, take a break, go out, smoke 2 cigarettes, and come back. Of course, those days you could even smoke inside the exchange. Good old days. But after 1987, we actually have circuit breakers like that. They don't necessarily stop big declines, but if there is no truly rational reason why the market should tank that much, it gives people a breather. Just go out, take a breath, come back, and trade again. Markets can also remain irrational a lot longer than you can remain solvent. Just because your position is correct does not necessarily mean you're going to make money, especially if you're leveraged. And back in 1987, there was a lot of leverage in the market. That's another thing that contributes. I'm a broker. You come to me and you say, I have $100, but I want to buy $200 worth of uh, NVIDIA. And I said, sure, why not? In fact, there is even an ETF of NVIDIA